Stop worrying about Nvidia's 1.77% dip. Seriously. If you saw the stock drop after record earnings and thought that AI trade is over, you just fell for the trap. Here is the counterintuitive truth that Bank of America understands. Nvidia just did what Apple and Microsoft did years ago. They raised their dividend from 1 cent to 25 cents per share, a remarkable 25x increase. The new yield is approximately 0.45%, aligning closely with Apple's 0.4% and Microsoft's 0.8%. Additionally, they announced an $80 billion share buyback. Revenue hit $81.6 billion, up 85% year-over-year, with gross margins holding at 75%. They also launched Vera CPUs, opening up a $200 billion new market. The CFO stated, visibility to nearly $20 billion CPU revenue this year. We're becoming the world's leading CPU supplier. The dip occurred because of zero revenue from China, along with Jensen Huang indicating supply constraints will persist throughout the Vera Rubin lifestyle. Let me break down what Bank of America anticipated and what you need to know now. I'll admit something. When I see a stock drop after blowout earnings, I get confused. Did I miss something? Then I read the details. Today, I'm going to show you exactly what Nvidia reported and why Bank of America remains bullish. We will look at the $81.6 billion revenue, the 25x dividend hike, the $80 billion buyback, the launch of Vera CPUs, and the reasons behind the stock dip. By the end, you will understand why this dip might actually be your opportunity. Stay with me. Let's start with what Bank of America predicted back in April. Bank of America suggested that Nvidia should raise its dividend yield from 0.02% to between 0.5% and 1%. The rationale? To attract new types of investors, including dividend funds and value funds. Nvidia's previous yield of 0.02% was essentially negligible compared to Apple's 0.4% and Microsoft's 0.8%. What did Nvidia do? They increased their dividend from 1 cent to 25 cents per share, resulting in a yield of around 0.45%. Additionally, they authorized an extra $80 billion for share buybacks. The counterintuitive truth? Bank of America called for this months ago, stating, cash returns could be the re-rating catalyst, and Nvidia delivered. Now let me show you the actual Q1 results. Revenue reached $81.6 billion, reflecting a 20% increase quarter-over-quarter and an astonishing 85% year-over-year, marking yet another record. The gross margin stood strong at 74.9% to 75%. For Q2, Nvidia is guiding for a revenue of $91 billion, plus or minus 2%, with gross margins expected to be similar to Q1. The counterintuitive truth here? Nvidia is guiding for $91 billion in Q2, which far exceeds most analysts' expectations, yet the stock dipped. Why? Two primary headwinds: supply constraints and an absence of revenue from China. Next, let's delve into the most underrated part of the report, the launch of Vera CPUs. Unlike their traditional focus, Nvidia is now targeting the CPU market, which represents a total addressable market of $200 billion. They are competing head-on with Intel and AMD. The CFO remarked, visibility to nearly $20 billion CPU revenue this year. We're becoming the world's leading CPU supplier. This projection isn't just a trial run, it's a full-scale launch. The counterintuitive truth? Nvidia is transforming from a mere AI chip company into a full-stack compute company, encompassing GPUs, CPUs, networking, and software. The potential for the $200 billion CPU market is now within reach. Let's discuss the reasons behind the stock dip despite all this positive news. Headwind number 1, supply constraints. Jensen Huang stated, we will be supply constrained throughout the entire life of Vera Rubin. This isn't vague, it indicates a significant and ongoing challenge. Why does this matter? Supply constraints directly limit Nvidia's ability to capitalize on demand. Headwind number 2, revenue from China is effectively zero. With US restrictions in place, Nvidia is not expecting any revenue from the Chinese data center market. The counterintuitive truth? Both of these headwinds were already known. Supply constraints have been a reality for over 2 years, and Chinese revenue restrictions have existed for at least a year. Allow me to share 3 secrets that connect these discussions. Secret number 1, the dividend re-rate catalyst. Bank of America predicted that enhanced cash returns would attract new investors, and that prediction has been realized. Secret number 2, the CPU expansion and visibility. Most investors still view Nvidia strictly as a GPU company when, In fact, Vera CPUs present a $200 billion market opportunity. Secret number 3, the supply constraint reality. Although frustrating, these constraints essentially serve as a moat. If Nvidia cannot meet demand, neither can its competitors. So what should you do with this information? If you're a long-term holder of Nvidia, ignore the dip. Focus on the impressive revenue and growth prospects. If you're a dividend investor, Nvidia's yield now stands at 0.45%, making it appealing for income funds now entering the fold. If you are a short-term trader, consider this dip as mere volatility. Q2 guidance indicates $91 billion in revenue, higher than anticipated. Thus, if the market overreacts to supply constraints, view it as a buying opportunity. The best time to invest in Nvidia is when the market is fixated on known headwinds, while neglecting the growth story. Supply constraints and China restrictions are familiar risks, but the Vera CPU launch and dividend hike are fresh and promising developments.